Hello, this is Mr. Smith, and today we want to look at the financial sector. So, this is the daily participation. Please make sure you click on resubmit and type the three most significant things from today's lesson. So, the financial sector is an organization, or I guess I should say, group of organizations that basically are involved in taking money from savers, holding it, and lending it to borrowers. And in return for their services, they collect interest off of those that they loan to, and then in some occasions give some of that interest back to the savers. Now, interest, or you could say returns or capital gains, or any of those types of things, any type of profit made, they are going to share some with the savers in most but not all cases. So the financial intermediaries are the institutions that are in between savers and borrowers. And so that includes, for instance, as you can see in the list on the left-hand side, banks, mutual funds, financial advisors, credit unions. Another one would be insurance companies. Basically, anyone that is taking money from us and then doing something with it in the form of investing. And investing includes what banks do when they loan money to people. They are investing in the economy. People can then go out and buy cars and homes and expand their businesses, and then they pay back that loan with interest. And insurance companies are the same way. Insurance companies also do not necessarily keep all of the money on hand. It depends on what type of insurance company you're talking about. Insurance companies basically do three things with the money. They, of course, keep some of it in order to pay out claims. So if you have an accident or someone passes away or you have a medical procedure. Second, insurance companies pay for expenses involved in actually administering the insurance, all the employees they have, for instance. And third, the insurance companies invest the money. And so they too don't necessarily keep everything. That's important to remember about all these financial intermediaries, including banks. When we put money into our savings or checking account, when we put money into a certificate of deposit or CD, when we put money into a mutual fund, and that money then goes out into bonds or whatever, when we give money to a financial advisor, one of the offices here in Titusville, for instance, when we put money to the credit union, when we pay our premiums into our insurance, all that money doesn't go into a vault and it stays there. That's not what happens. These institutions or individuals then take that money and then invest it in some way. They either buy stocks, they buy bonds, they buy real estate, they loan out the money, some type of investment that occurs. And so what the financial intermediaries do is they convert savings into investments. They provide cash facilities. In other words, there's cash there that we can, of course, have access to, like in the case of banks and credit unions. They also provide loans because without loans, individuals or entities such as businesses would not be able to make large-scale purchases. And they assist clients to grow their investments. And so that especially is true with financial advisors, those that we have a more close relationship directly with. Banks, that's not necessarily the case. They do have ways that they can help you invest. For instance, I mentioned certificates of deposit. A savings account is a way of investing because you earn a small amount of interest, although it's not the most. And of course, with these financial intermediaries, the safer they are, the less risk they have, and the less reward that you get. The more risky they are, the higher the reward could possibly be, but also the greater the risk. And so when you go with a financial advisor, for instance, that is going to invest in the stock market that is riskier than bonds or having money in a checking account, because of that, you're going to get a higher rate of return than you would on that savings account, for instance. The savings account is the safest, so it gets the lowest rate of interest. But anyway, they do help you invest. And even if you're just putting money into a checking or savings account, in a way, you're investing macroeconomically in the economy, since banks then turn around and loan that money out to help everyone else purchase large-scale goods and services. So the advantages of the financial intermediary is that it lowers the default risk because it's spreading risk everywhere, causing diversification to happen. It saves time and cost because obviously each time you get your paycheck, you don't want to have to think, well, where should I put this money, and should I pool it with other people to loan out? The banks, the insurance companies, the financial advisors already have all that worked out. It helps customize services for clients because obviously if we just want to save money, we put it in a bank. If we want to invest it, we go to a financial advisor. If we want it set aside for special costs such as health insurance or car insurance, we go to an insurance company. And it lowers the problem of asymmetric information. And that, of course, is when there's information failure, basically, when not enough information is necessarily there for individuals. So we don't obviously have the time or the speciality to study financial investments so in depth, and so these other institutions do that for us. So it lowers the problems involved in asymmetric information or lack of information or expertise. So these are the benefits of the financial intermediary system. A lot of accusations get thrown around going back to the time of Andrew Jackson that banks only help out the rich. Using the word only is inaccurate. Do they help the rich more? Well, obviously they do, because the rich have more money. And the more money you have throughout your life, the more advantageous banks and financial advisors will be to you. Obviously, the less money we have, the less advantageous these institutions are. So often you hear in some kind of class conflict construct, financial intermediaries don't help the poor as much. They don't help the working class people as much. Well, that's because if you don't have a lot of money, then they're not able to help you, because that's what they deal with. They deal with money. So obviously, the more money you have, the more helpful they can be, which is why some people, of course, look at them skeptically, but that is overall their function.